I welcome today's speaker, CA Shripal Lakdawala, on the Nagar CP Study Circle platform. Topic for the today's webinar is Taxation and Structuring of LLPs. Thank you, Sripaji, for accepting our invitation for sharing your knowledge. I now request our core group member, CA Jayesh Thakkarji, to introduce today's speaker.
Thank you, Convener C.S. Imam Mehta, Madam, and our Deputy Convener C. Krishna Kumar, sir, and all our members of JB Nagar CP Study Circle of WIRC of ICI, for giving me this opportunity to introduce our today's lunch speaker, C.A. Shripal Lakdawala, on the today's topic, Taxation and Structuring of LLP. C.A. Shripal Lakdawala is the partner in Deloitte Haskins and Sells LLP, and he's into the practice of merger and acquisition tax practice at Mumbai, and he's having the vast experience of almost 2 decades post his qualification. He has authored various articles which are published in the leading newspapers and the online portals in India. He's having the vast experience in advising the clients in the corporate structuring and domestic and cross-border merger and acquisition related issues, capital restructuring, and also having the experience on tax and regulatory matters, which involves due diligence in relation to the direct tax matters. He served members and the clients, including the various areas of the core economic sectors, including manufacturing, infrastructure, energy, and real estate sectors. So with this brief introduction, now I would like to welcome today's speaker, CA Shripal Lakdawala, to deliberate his views on today's topic. Welcome, sir.
Good evening, friends, and I hope all of you are doing good and all your loved ones and all are safe in this really testing times. So I have been operating from my home for a little over a year now. We started exactly on 12th of March, and today is 13th, so of March in the next year. And at the outset, I would like to thank Seema for inviting me on this platform. I have done a few sessions with ICAI, ICSI in some of the CP study circles. But one thing that I've really found unique about the group here is the sheer number of members and also the number of members who are present and attending this session today. And that made me kind of a little nervous, if not very nervous. And the second thing which I would want to really appreciate is never have I ever had questions coming to me before even sessions were taken. So when yesterday I received some message from Navnath with questions, I was kind of amazed to see those questions. So this is good, and it will be my endeavor to address those questions when I'm speaking. And I will request members to also post questions on the chat box. This is a virtual platform, so it will be difficult to have it as an interactive session with so many people on board. And we have factored close to 2 hours for this. I have about 40 slides with me, and I would believe that we will have enough time to discuss and deliberate on any questions which are there. But my commitment to Seema and all the members here is that if I'm not able to answer some question for want of time, or for if I need to look up, I will come back by Monday evening in an offline mode to the respective member. So you'll have to bear with me for that if that arises. And it's a virtual session, so I'm doing it for the first time. I will not be able to gauge whether my audience is with me or not. So if you believe that I'm either going very fast or I'm going very slow, or you want me to change the pace, etc., please reach out to Jayesh or Seymour, and they will give me a prompt, and that will I can change my way I'm doing it. With this, I have put up a slide over here, slide deck. Is it visible to all?
Yes, it is visible, and you're going good. There is no problem. with your voice, and it is quite audible.
Thank you.
You can continue. Thank
So,
you.
so the brief content, and this slide deck will of course be shared with everybody. I was a little late, so we can look at it together, and then subsequently you can have it with you. So these are the brief content which I'm going to cover today is some insights on LLP and how it has evolved, taxation of LLP, conversion, restructuring, and some LLP structures or case studies which I have kind of put towards the end. Now, LLP as a law is evolving, and when I can say one thing with conviction is I became a chartered accountant in 2000, and I have seen this law evolving. It actually was enacted in 2008, and thereafter in 2009 2010 provisions in relation to taxation for LLP were enacted in the Income Tax Act. Now it's a new law. It is evolving, and it is governed by a charter document which is called as LLP deed, and it is there is an LLP Act. uh, if one were to go back to say I'm going to spend couple of minutes on this year because it is important to for some things to be correlated later. Why was there a need for an LLP? There was a need for an LLP because we had partnership and then we had company. Now partnership did not have a perpetual succession, and there was a limitation on number of partners, etc., and partnership could not have held assets, and banks, etc., were also not very comfortable. So therefore there was a need to have another form of entity, business entity, which can be there, and which could have a perpetual succession, which can own assets, and also there's the liability of the partners is limited. And for all these reasons, the LLP Act was formed. There is LLP is a separate legal entity. It is separate from its partners. It is, as compared to a company, it has got less compliances. It's a partnership firm, so there has to be mandatorily two partners, and of which one has to be a person who is a resident in India, who will be designated as a designated partner. It have two designated. One can be a resident in India, and your part, the liability of a partner in a partnership in an LLP is restricted to the capital which the partner has put, unless there is a fraud, in which case the liability can be unlimited, but otherwise the liability. So it has a characteristics or it's an amalgam of a partnership firm and then company, so to say. Now going to the next slide in terms of why LLP. LLP can be formed either by registering a new LLP, or it can be formed by converting an existing partnership firm or an existing private limited or an unlisted company. And who can be partners of LLP has been a question, and while the LLP acts as individuals, body corporate, even foreign companies, and LLP also can be LLP also can be a partner in another LLP. The question that really comes up is, and which I have encountered on a few occasions, is whether a trust can be a partner in an LLP. And the answer to that is no. A trust can technically not be a partner, but a trust through its trustees can be a partner, where a trustee may make a declaration back to the trust to say that the interest in LLP that I am holding is on for and on behalf of the trust. But a trust per se cannot become a partner. And this question has come up because several corporate groups or promoters or business houses have started holding their interest in their ventures through a trust, and therefore this question always comes up. The other benefit is provisions of deemed dividend and presumptive taxation, which are draconian under the Income Tax Act, are not applicable. One can say, to breathe it easy, to say Indian accounting standards or Ind AS are is not applicable. Another good thing which is then, and the government has been trying to promote LLP as a business entity, and two things which they have done in particular to attract foreign investments into LLP is, one is they have liberalized FDI. So earlier, uh, while from 2008-9 till almost 2014, a foreign direct investment in an LLP was prohibited. and therefore foreign investment was not coming in. Now RBI has relaxed it, and what they are saying is you can get foreign investment into an LLP, but the condition is that it should be in a sector in which FDI is permitted under automatic route, and there are no performance linked conditions which are there. And as late as 2017, the ECB into LLP has also been liberalized, and now subject to compliance with the ECB guidelines, and LLP also can raise money by way of ECB. And there are limitations in terms of IPOs, listings. ESOPs cannot be implemented, because if you want your employees to get some interest in the company, you can give an ESOP, but here you will have to make them a partner, and it is difficult to have tag along rights for the partners. Now, moving on to taxation of LLP under the Income Tax Act. When the LLP Act was legislated, unfortunately, they had not done anything in the Income Tax Act in that year, and therefore, for almost 6 months while the Act was there, nobody was going ahead and forming an LLP. In fact, I can tell with a lot of pride to say the first 5 or 10 LLPs which were incorporated, I was working on at least 2 to 3 of them for my clients. So, but things started moving only when clarity was brought with respect to how the LLPs will be taxed. And government or the then government, and even the subsequent governments, have thought it appropriate to say that let us not make any differentiation between LLP taxation and a partnership firm taxation. And to provide that, they essentially made 3 amendments. They changed the definition of the term partner, definition of the term firm, and definition of the term partnership. And it was include a partner in an LLP, a firm included an LLP, and a partnership also included an LLP. And this essentially is the change which was done in the Income Tax Act to start with. And they said all the rules, regulations in respect of tax which are applicable to a partnership firm would be applicable to an LLP. So this was the first thing. Now, one has to look at what is residential status, and when we look at section 6(2), it says a firm is said to be a resident in India in any previous year, in every case except where during the year the whole of the control was outside India, wholly outside India. Now, while this may be relevant for a partnership firm, because you can have 2 partners who would have formed a partnership firm, and then the firm is doing business, employees are managing the business, and they would have become non-residents. This applies in that case, but here, because in the previous slide I did mention that there's a need for having a designated partner in India. You need to have at least one designated partner who is in India and who is a resident of India. A LLP can never be said to have its affairs wholly outside India, and therefore, one can also put it differently to say LLP will always be taxed as a tax resident in India. The only situation in which this issue may arise is if the designated partner passes away and the other partners are all non-residents, and there is no amendment which is done to the LLP deed. Then in that is the only situation in which it can be treated as a non-resident. Otherwise, LLP would always be treated as a resident in India for tax purposes. Now, coming to taxation of LLP in terms of remuneration. Now, any payment which is done in form of a salary or a remuneration paid to partner, bonus paid, commission paid, etc., would be allowed as a deduction, provided it is not something which is not paid to a person who is not a working partner. It has to be in accordance with the partnership deed. It has to be for a period post the date of the deed, and it should not be exceeding the prescribed threshold. If this is the case, then it is allowed as a deduction. And correspondingly, in the hands of the partner, there's a provision, I think 28(5), if I'm not mistaken, which very clearly provides that this would be taxed as profits and gains from business and profession. This is a settled law because partnership firms have been there in existence much long back before even LLP Act was formed, and per se there is no dispute around this. Similarly, interest which is paid on the capital. Now, payment of interest also, it shall not be deducted only if it is not in accordance with the deed. It relates to the period prior to the date of the deed, or it is exceeding at the rate of 12% per annum. If it is within 12% in accordance with the deed, then the interest paid to the partner would be allowed as a deduction. And similar to any remuneration or salary which is paid to the partner, the interest also would be taxed as profits and gains from business and profession. Coming to the profit share, LLP will be subjected to tax at the same rate as any partnership firm would be subjected to tax. And in the hands of the partner, the interest, because there is a specific exemption which is provided for partnership firm under 10 subsection 2, any share of profit which is received by a partner would not form part of the total income. Now, one thing this is holding true for partners who are resident in India. However, if we have an LLP which has got partners who are not resident in India, then one will have to look at what is the taxability in the home country in respect of the share of profit which would have been received by them. Okay. Another aspect in relation to, and this is going to be extremely interesting, on transfer of capital asset. So we all know that under section 45 there is a specific provision to say that if any capital asset is transferred by the partner to a partnership firm, then the value at which the capital asset is recorded in the books of the partnership firm would be deemed to be the full value of consideration for the purposes of computing capital gains tax in the hands of the partners. Now, this is a settled law, and because LLP will also follow what is followed for partnership, this holds good even there. However, there is a twist over here. So, when we look at the twist, now capital contribution, one needs to look at Income Tax Act, and then one also needs to look at the provisions in the LLP Act. There is a section, which section 32 in the LLP Act, which speaks about modes of contribution, and modes of capital contribution could be cash, could be kind, which is say tangible, intangible, movable, promissory notes, etc. And there's another thing which is regulation 23. Now rule 23 rather. Rule 23 clearly provides that when a contribution is made, the contribution will have to be fair valued by a CA or a cost accountant or an approved valuer for the purpose of accounting. So typically, what's the structures that we have, when somebody is contributing an asset to a partnership firm with the view of deferring the taxation, because it's a partner is giving his own asset to a partnership firm as a contribution and nobody wants to pay tax. Typically, people go ahead and record the assets at the carrying value, or at at best at what is the index cost in the hands of the partner, to avoid paying any capital gains tax. However, if a but this is in case of a partnership firm. But when we come to LLP, the thing changes, because there is this section 32 read with rule 23 of the LLP rules. There is a need to do a fair valuation and record. Now, if I were to go ahead and do a fair valuation and record the assets at fair values, uh, then one has to go back to section 45(3) for computing capital gains tax in the hands of the partner, and a partner possibly could be subjected to capital gain tax if the fair value which is arrived at by the valuer and which is accounted for in the books of the LLP is higher than the index cost of acquisition for the purpose of computing capital gains. Now, one question is capital contribution by a partner, can 56 to 10 be made applicable? My view is that 56 to 10 should not be made applicable when a partner is contributing, because when a partner is contributing something, it is not without consideration. It is for a consideration, and the consideration essentially is interest in the LLP which he is getting. So it is like an adequacy. So there are two limbs in section 56 to 10 which are there. One is without consideration, and second limb is inadequacy of consideration. So it is certainly not without consideration because it is for a consideration. Now the second limb is inadequacy, that cannot be questioned or challenged, so to say. There is a Sunil Siddharth bhai also, which is coming to the rescue. But more than that, it's a commercial thing, it's a venture that he is entering into, and for that he is contributing something to the partnership firm or to the LLP, and that cannot be deemed to be for inadequate consideration. Okay. Then next is taxation of LLP on distribution of capital assets. So a lot has happened over here in the budget, or the budget proposal, so to say, and which have not yet been finalized. So any profit or gain arising on a transfer of a capital asset. So this section 40, we spoke about 45.3 is when assets were received by the LLP. This is 45.4 when assets are released by the LLP. So any profit or gain arising on a transfer of a capital asset by distribution of capital asset on dissolution of an LLP will be chargeable to tax, and it will be chargeable to tax in the hands of the firm. So this is the law which is there as on date, and it for the purpose of section 48, the fair market value of the asset will be deemed to be the full value of consideration, and from that full value of consideration, the cost will be reduced, and thereafter capital gains will be paid by the firm. Now, what has happened, in the budget, there have been certain changes which have been done, and if one were to, I'm going to spend close to 5-7 minutes on this. Is if one were to say why those changes were carried out, there were certain things which were laid down by some of the jurisprudence, which was interpretation of law, and which was used, and there was some element of abuse which was happening with respect to partnership firms and LLPs. And what was the abuse? So if there is a reconstitution of the firm which was happening under section 45.4, where one partner is retiring and other partner is admitted to the partnership firm, what was being done was, no partner will retire without taking his fair share from the partnership firm. So the partnership firm would be fair valued, and whatever is the fair value, one will create a goodwill for that, and that goodwill was kind of credited to the partner's capital account. So, and the incoming partner will bring the money into the firm, and the outgoing partner will take the money from the firm. And section 45.4, which we spoke on the last slide, was interpreted to say section 45.4 is applicable when there is distribution of a capital asset. When a partnership firm is returning capital to its partner on on any reconstitution which is happening in the firm, then that reconstitution is not dissolution, and payment of cash is not payment, because partnership firm is not parting with any capital asset. It cannot be brought to tax. And this was kind of being litigated by tax authorities every time. There were judicial precedents, because there's one judicial precedent in, I think, in the case of A.N. Nayak, which had interpreted section 45.4 very differently from rest of the courts and tribunal, where Bombay High Court said or otherwise, which is used in section 45.4, would also mean retirement of a partner from a partnership firm. If people are interested, I can read it from the act, just for like, so I'm reading 45 subsection 4. It says profits or gains arising on transfer of a capital asset by distribution of a capital asset on dissolution of the firm or an AOP uh, or otherwise shall be chargeable to tax as income of the firm. And Bombay High Court in the case of AN Nayak went ahead to interpret or otherwise to even include retirement. But there were no other high courts or tribunals which were concurring with the view expressed by Bombay High Court in the case of AN Nayak. Now, so what are the amendments which have been carried out? And these are very significant amendments because this is going to change the way in which a partnership firm or an LLP is going to be reconstituted going forward. So, what I have done is for benefit of everybody, I have tabulated it to say, okay, what is the existing provision and what is the proposed provision in the budget. So the existing provision, as I read, gains arising on distribution of a capital asset on dissolution of a partnership firm or otherwise to its partners, taxable in the hands of the firm. Now, this provision is now going to be replaced, and it is going to say any dissolution and reconstitution of the firm. So, this is also going to apply where there's going to be reconstitution as a result of some partner exiting the firm and some partner coming inside the firm. And any gain arising on transfer of asset to be taxable in the hands of the firm. So, this is going to be, this remains the same. And then it goes ahead to say computation mechanism which they have provided. It says full market value will be deemed to be the consideration. So if a firm has parted with a capital asset, then full market value of the capital asset is going to be deemed to be the full value of consideration. And the cost of acquisition is of the asset in the hands of the firm, or if a cost asset is introduced by the partner and the FMBH it is initially recorded or for the purposes of taxation will be considered to be the cost, and then the computation mechanism as is provided under section 48 will be applied. So this is one change. The essentially the change is that even in reconstitution this is going to be made applicable as against only dissolution which was there earlier. Along with this, there's another amendment. So a new subsection has been proposed to be introduced. The new subsection is section 45(4)(a). It says that cash distribution was not taxable, or rather is not taxable at present in the hands of the firm. The proposal which is there in the finance bill seeks to change this position which is there. It says any gain made by a partner would be taxable in the hands of the firm. So any distribution of cash or any other asset on dissolution or reconstitution of the firm is also now kind of captured. So the abuse which was there in terms of, and I would I don't know if we can call it abuse because it was blessed by judicial precedents, but or we can say that this was something which was traditionally adopted as an approach to say how do you reconstitute or retire a partner in an efficient manner. And this was also backed by judicial precedents or interpretations from court. So it was not, but now this has all been set to rest. It says gain made by a partner will be taxable in the hands of the firm if it is on account of distribution of cash or other asset on dissolution or reconstitution. Now, one thing which is made very clear is the computation mechanism is money if it is cash or fair market value of asset is deemed to be the consideration. So whatever is the fair market value of asset, if any other asset other than capital asset is given out, or say for example a stock in trade is given out, then whatever is the fair market value of stock in trade would be considered as full full value of consideration, and that will be compared with the balance in the capital account of the partner, and the balance in the capital account will be treated as cost. They've gone ahead to say that if in the capital account there has been any credit on account of revaluation of assets or on account of self-generated goodwill in past, and the same is tending to the credit of the partner's capital account, then the same will have to be ignored for the purposes of computing the balance in the capital account. And one will have to compare the gains. In arriving at the gains, one will have to compare the money and the fair market value of asset with the balance in the capital account, and that difference will be taxed as capital gains in the hands of the partnership firm or LLP. So this is one change which is there. Now, this amendment is effective from FY 2021. So this amendment, as and when it will be legislated, once the finance bill is approved by Lok Sabha, Rajya Sabha, and it receives President's confirmation as well. This will be applicable for the current financial year. So if in the current financial year, if any partnership firm or any LLP was reconstituted, or there was any dissolution, or where any partner had retired from the partnership firm and some payouts were made, the capital gain tax liability in respect of the payouts made to the partner will have to be reworked, and possibly or one will have to factor it in the advance tax payments which the partnership firm or the LLP will have to make, considering that this is brought now. Everything will have to be factored in the advance tax payment which is due day after tomorrow. So we've just put a couple of illustrations explaining what this previous slide. So this is the first illustration is where we are assuming that the fair market value of the capital asset. So there is a capital asset which is distributed and is say 200. There's no other distribution, so total distribution is 200, and cost of asset acquired is 40. Then the capital gains which is taxable in the hands of the firm will be 200 minus 40, which is 160. So this will plug the loophole on litigation which is there, and that's the mindset with which the government, in fact, if one were to read at the explanatory memorandum which they have provided, they have covered everything threadbare. Moving on to the second illustration in this regard, which is distribution of a capital asset. So here there is fair market value of other assets distributed is 100. So it's not a capital asset. Cash distributed is 50. Now total distribution made is 150. And the balance in capital account is 100. Now if this is the fact pattern, then 150, which is the total distribution, will be deemed consideration, and the balance in the capital account will be considered as cost of acquisition, and the partnership firm or the LLP will be subjected to capital gains on 50. This is under section 45(4)(a). In the last of the illustrations, so the fact pattern remains the same in terms of distribution, which is 150. Now, and the balance in the capital account is 120, but 120 includes 20, which is on account of self-generated goodwill. So the deemed consideration here once again will be 150. 100 will be considered as the cost of acquisition and not 120, because any credit to the partner's capital account on account of self-generated goodwill or on account of revaluation will be ignored, and capital gains will be on the difference of 150 minus 100, and 50 will be subjected to capital gains in the hands of the firm. So this has been a significant change which is coming our way if the finance bill proposals in the finance bill are accepted by Lok Sabha and Rajya Sabha, and it will change the way a partnership firm will be reconstituted going forward, because there will be very little leeway available for not paying any capital gains at the time of exit of a partner from a partnership firm. Coming to the rate card, I've just included for completeness on the taxation aspects of LLP. So an LLP is subjected to tax at the rate of 30%. And if the income of LLP is up to 10 million, that is rupees 1 crore, then there is no surcharge, and therefore effective tax comes to 31.2. But if the income is in more than 10 million, then there's a surcharge of 12% and effective tax. I mean, when I say effective tax is surcharge plus education cess, everything comes to 34.94. So the thumb rule with what we say is an LLP is taxed at 34.94% if the income is more than a crore of rupee. Now there is an alternate minimum tax. Then AMT is payable only if there are any Chapter 6A deductions or 10AA or 35AD, which is claimed by the LLP. And that would be at the rate of 18.5%, and the effective rate will be 19.24 or 21.55, as the case may be, depending on the total income. If an LLP is set up in IFSC, then there's a differential rate which is provided for AMT, and AMT in that case will be 9.36 and 10.48%. I have come across couple of LLPs which have been set up by professional services firms, who are catering to the clients who are operating out of Gift City in Ahmedabad, and or they are doing back office support for their clients outside India in terms of accounting or doing some kind of back office work, and they're operating from there. In that case, the rate will be lower for AMT. And as we all know, the dates for filing returns are 31st July if there is no audit, 30th September if there is an audit, and 30th November if it is also subject to transfer pricing. So these are the 3 dates which are critical for LLP. Now, coming to losses and recovery of tax. So there is a specific provision which is, I think, section 78 in the Act. It says that in case of change in constitution of a firm, the losses proportionate to the share of the retired or the deceased partner as is exceeds his profit shall not be entitled for carry forward and set off. So put it simply, if say there are 3 partners in a partnership firm, each of them are having 33% share, 33.33% share. If one of the partner retires, or one of the partner is no more, and then to that extent, the losses will not be allowed to be carried forward and set off in future, but the balance losses will be preserved. And also, if there's say any succession in part business or succession other than by way of inheritance, so if say a partner inherits the interest in partnership firm from the deceased parent or the deceased, then then the losses will be preserved, but any other succession which takes place, the losses will not be preserved. Going to recovery of taxes, any interest penalty due from an LLP or a tax which is due from an LLP for any previous year, every person who was a partner at that relevant time would be jointly and severally liable. So while the liability of a partner is limited to the capital, but when it comes to the government, it is unlimited, because then every partner who was a partner at that time will be jointly and severally liable. If a partner wants to or is able to prove that non-recovery cannot be contributed to his gross negligence and or breach of duty on his part, then is the only exception which is there. So per se, when it comes to government dues, I would believe that a LLP would be not be a limited liability, but to that extent it becomes unlimited liability, but only for specific to the government dues. There were some questions on assessment of firm, etc., but your so when will an LLP be assessed as a firm? So it's very clear for some a partnership firm or an LLP to be assessed as a firm, it has to be evidenced by an instrument. So here there will be an LLP deed, and in case of an LLP, instrument is always there, because there is a need or a necessity at the time of constituting or incorporating an LLP to have a LLP deed, which is kind of uploaded on the MCA website or the ROC website. And individual shares of the partners are specified in the instrument. So if individual shares are not specified, then it cannot be assessed as a firm. But if it is, and what happens if, like, there's a non-compliance, so the individual shares are not specified, or there is a firm which is set up but there's an oral deed, like, per se not possible for an LLP, but in that situation, no deduction by way of any payment of interest, salary, bonus, commission, remuneration will be allowed in computing the income chargeable to tax for the partnership firm in the profit. And the said payments, if they are not taxed, tax deductible in the hands of the LLP, then correspondingly they can also not be brought to tax in the hands of the partners. And there is a, as we spoke on the earlier side, the liability will be joined in several for every partner and the legal representative of the deceased partner in case of death or demise of a partner. Now coming to the next part, which is change in constitution stroke succession. Now, if at time of making an assessment, or so first let me go to say that under section 184, there is a need to file the instrument evidencing the LLP or the partnership when the first return is filed. There is also an obligation to say if there is going to be change in constitution, then also there is a need to file the revised deed along with the return of income. So when there is a change has occurred in the constitution, the assessment will be still done on the LLP as constituted at the time of making the assessment. So that LLP as it is there at the time of making the assessment will be assessed. And it's not that for the period of prior to the change in constitution, that assessment will be different post constitution. That is not going to be the case. Now, if an LLP were to be succeeded by another LLP in business, so the business of LLP is taken over, then separate assessments will be made for predecessor and successor LLPs. And if there is a discontinuation or the LLP is dissolved, the income tax authorities will still make the assessment on the income of LLP as if no discontinuation or dissolution has taken place. And once again, if there is any liability, then that liability vis-a-vis government will be joined in several for all the partners. Seema, Jayesh, I'm just doing a quick check. Am I, do I need to change the pace? I'm going fast, slow, etc.
No, it is good, means.
Okay, thank you. Okay, now the next thing is when taxation of LLP is transfer of partners' rights. So any assignment or transfer of partners' interest is provided in section 42. Section 42 of the LLP Act is very liberal. It says the right to share profits and losses or to receive distribution recordings are transferable wholly or in part. So a partner can go ahead and transfer his right to receive profits or receive distribution from LLP pursuant to an agreement to some third party. Now, but this is a very differently worded section. But this transfer of partners right does not cause a disassociation of the partner or dissolution or winding up, because unless the other partners in the LLP were to take cognizance of this and admit that person to whom the share of profit or right to receive has been assigned, that person automatically does not become a partner of the LLP, and that also does not amount to dissolution or winding up of an LLP. So this is going to give rise to I have practically not seen in close to 12 years of LLP being around that if this section has been used by anybody But the very fact that it is there, and it may come to use someday, and it how this tax authorities are going to look at it is going to be very interesting, because the assignee or transferee does not become partner. Now when he receives a share of profit from the partnership firm pursuant to a contract or an agreement with the partner who has transferred his right to receive distribution, that is not exempt in his hands, because it would have been exempt in the hands of a partner under 10(2). Now this person is not a partner under 10(2). So how does it work? So this is something which will evolve, I would believe, over a period of time. Now question is, if one were to say that partner's interest in an LLP is an assignable asset, or it is assignable, or is it a capital asset? It can be regarded as a capital asset and can be subjected to capital gains. And if the answer to this is yes, then what is the cost of acquisition of such right? I have not ceased to be the partner. My capital in the partnership firm is intact. What is the cost of right that I have today? And can one say that it cannot be, we like can it be the capital contribution? Can one say that we have, it cannot be ascertained, and therefore the principles laid down in BC Srinivasa Shetty will be applicable? Some of these are open questions, because there is no cost which is there. The cost, if at all is there, is with respect to the interest in the LLP, which is still intact, because LLP is not going to disregard the person as a partner. The second question which arises, will 56(2)(10) be applicable on such assignment or transfer? 56(2)(10) is applicable in the hands of the recipient. It is a recipient taxation. So if I am a partner in an LLP and I have assigned something to somebody to say, okay, I'm assigning my right to receive all profits and distributions in future to you, to another person, say, and that person pays me something, it's a sum of money which I have received. So it is one of the asset which is referred to in section 56(2)(10). And therefore one will, once again the question comes is whether there is a consideration. Yes, there is a consideration. It is in consideration of my giving up of the right to receive. Now adequacy of consideration, it's going to be extremely subjective to say whether it is adequate or not adequate. But since this is kind of not done, at least I have not seen, if somebody would have encountered something like this, then this is going to be extremely interesting to see how this is going to be worked out. Okay, moving on to next is conversion of LLP, and I had one question which was there, was specifically on conversion, which is not covered in my deck, but I'm going to talk about that. So one is conversion of a company to an LLP, and we've kind of covered over here 4713B. So if one were to comply with the conditions which are there, because there's a specific uh, provision which is there under section 47, so which says that if these conditions are complied with, then the conversion of a company to LLP would not be regarded as a transfer and therefore not subjected to capital gains. And the second situation is when it is not in compliance with section 4713B. Now, one more aspect of conversion which could be there is conversion of an LLP into a company. And the question which I had received was for conversion of an LLP into a company. So there also, there is a specific provision which is section 47 subsection 13, which talks of conversion or transfer of a capital asset of a part of a firm to a company, or in succession, or for at the time of conversion. So there are 4 conditions which are prescribed, and subject to compliance with those 4 conditions, it would not be taxable as a not a taxable transfer and not subjected to capital gains. Now, so this actually 4713B has been the hot question of debate. 4713 has been there in the act for a longer time. Like, my recollection was it was brought by in FY 99, financial year 99. So that's been there for a little over 2 decades. The 4713B has been brought in after LLP taxation was introduced, and a lot of closely held companies who are struggling with MAT liability, who are struggling with dividend distribution tax and other issues, have sought to convert them from a company to an LLP, and there are certain challenges which are there. So the provision as it is there, it says there is an eligibility criteria. Then there are certain conditions which are prescribed at the time of conversion, and there are certain conditions which are there, which are conditions post the conversion, which need to be complied with. The first is this section will be applicable, or this exemption which is provided under 4713B is with respect to those companies whose gross receipt from business does not exceed INR 6 million in any of the 3 preceding years. Now, you're it's gross receipt of a company with what I've written, but it is very interesting to see what is there in the act. The act, and it says the total sales or turnover gross receipt in business of the company. Now, in business is very critical to read, because see, if a company is set up as an investment holding company, and one wants to convert an investment holding company which is receiving dividends in excess of 60 lakhs, can one argue to say that dividend is income from other sources and it is not my business receipt? Because when I read it to say gross receipt aggregate, total sales turnover or gross receipt in business, so do I have to include my total gross receipts, or I have to include only gross receipts from business and profession? So that is one area, gray area, which is there. A prudent view would be that you have to take gross receipts from business and profession, but there is no clarity. So only over a period of time, when things reach tribunal or high court, we will have some more clarity. And it is for the 3 preceding years. The other conditions which are there is that all assets and liabilities have to be transferred to the LLP of the company. Shareholders of the company will become partners, and their capital contribution and the profit sharing ratio in the LLP will be the same. So if I'm a partner in a, or I'm a shareholder in a company holding 25%, and that company is proposed to be converted into an LLP, then in the LLP my profit share will be 25%. So that proportion has to be maintained. And the shareholders of the company do not receive any consideration other than by way of capital contribution in LLP. So I should not receive any other consideration. There's another numerical limitation which has been built in, which is saying that the total value of assets appearing in the company book should not be more than 5 crores. Now, here also there can be two questions which can come. Is when I have to look at value of assets, do I have to look at historical cost? See, if I'm an investment holding company and I'm holding, historically I'm holding say 4 crore 50 lakh worth of shares. So I have subscribed to 45 lakh shares at 10 each in a company, and my historical cost is 4.5 crores. But the market value of those shares is say 50 crores. Would this condition be applicable? My view would be you have to look at what is the book value or the historical cost which is there, because they are saying in 3 preceding previous years. So I have to look at 3 preceding previous year book value only. Should not exceed 5 crores. Now the question that arises is, by putting a cap on the value of asset and the amount of turnover, what essentially the message the government or the tax authorities are giving is they want smaller firms or smaller companies who had set it up as a company because there was limitation at that point in time on partnership form, and they were compelled to operate as a company, and they want to go back to the LLP, which is more akin to a partnership. Then we will facilitate that and will not bring it to tax for them. But if you're a large company, you cannot convert yourself without paying taxes. And there are two other conditions which are there, which are condition subsequent, so to say. It says aggregate of profit sharing ratio of the shareholder in the company shall not be 50%, less than 50% during the period of 5 years from the date of conversion. So I can dilute, once first condition is that I need to be proportionately become a shareholder. After having become a shareholder on a proportionate basis, I can dilute in the company. So I can get a third party investor, or I can get another fellow shareholder to come and subscribe to the company. But my dilution cannot be more than 50%. A way around this is people have actually gone ahead and issued optionally convertible debentures, or compulsorily convertible debentures, or a compulsory convertible preference shares, which are convertible at after a period of 5 years, and still you've achieved whatever was desired, but you are in compliance with the condition which is mentioned over there. And this is going to be litigated by tax authorities. So because they never had something called a tool called GAR till now, but now they have GAR, and they may say that you've structured it in a way that you want to violate this for tax purposes, and they could apply GAR. The other condition is you cannot convert and then take the money out. Had you not converted, you would have paid capital. I mean, you would have paid dividend distribution tax earlier, and now tax on dividend in the hands of the recipient. So, if you're going to convert it, then for the period of 3 years, whatever is the accumulated profits in the LLP will get locked in, and after 3 years, you are free to remove the money from the company. So, these are the conditions which are there. Okay. Now, some of the key considerations is accumulated losses, unabsorbed depreciation in the hands of the company. If the conditions in 4713B are complied with, will be allowed for carry forward by the successor. So losses in the company will become losses in the LLP. Any MAT credit which is available will not be allowed, regardless whether conditions are satisfied or not satisfied. Any benefit of amortization of VRS payments shall also be applicable. Depreciation will have to be apportioned between the company and the LLP on the basis of number of days of usage in the year of conversion. So depreciation will be proportionate. Actual cost of block of assets in case of successor LLP shall be the WDV. So WDV will become the actual cost for the purposes of claiming depreciation. And cost of acquisition of a capital asset, being rights of a partner received in consideration for transfer of shares, shall be deemed to be the cost of acquisition to him in the predecessor company. So it means the cost remains the same. So these are the fallouts of conversion under 4713B. Now, what happens if it is a non-compliant conversion, and what are the arguments which are there, and what are the potential issues which are there? Under the Income Tax Act, from a company's perspective, it is possible to argue that there is no transfer. There is this very famous ruling of Bombay High Court in the case of Texpin Engineering, which held that there is no transfer of a capital asset when the firm is converted into a company. And same principles can be applied on conversion of a company to LLP, because broadly the principles will remain the same. It is a very interesting ruling. I've read it, and it says okay, it kind of goes on to say that nothing changes. I was wearing a robe or a jacket where I was assessed as a firm, and if I want to, I'm only changing that to say I'm company. I'm person remains the same. Nothing changes, and therefore there should not be any taxation. So this is a possible argument which one can take. The other thing is there was no specific provision like 4713 or 13B at that time when when the taxpin conversion took place. The one argument which can go against is okay, there is a specific anti-abuse provision which is there, or there is a provision which is providing for conditions to be complied with. If you're not going to be in compliance with this condition, then it should be taxable. But this is litigative because there is a favorable ruling. So, but one will have to wait and watch how it turns up. Now, for shareholder, what are there's a potential capital gain tax implication on conversion of a company to an LLP because there is a transfer. There's a transfer of the extinguishment. The shares are extinguished, and in consideration, he is receiving or he or she is receiving interest in the LLP, and this would be subjected to capital gain. And from an LLP's perspective, since 47 was not LLP would not be liable to pay any capital gain in the 47A4, if conditions are not complied with in future. And because the company has gone out of existence, if the courts were to go ahead and hold that the company has also transferred capital assets to the LLP, the capital gain tax implication in the hands of the company may be recovered from the LLP as successor by invoking provisions of section 170, because successor cannot be found, and liability under 170 for the year in which the transfer takes place or the succession takes place and year before that would fall on the successor. Now, we do have benefit of couple of case laws where it is non-compliant. So recently, this Mumbai Tribunal judgment, if I'm not mistaken, this is post 2018. Mumbai Tribunal, in case of celerity power, held that conversion of an asset and liability at book value. So, there is a conversion and the transfer takes place at book value. There is no gains in the hands of the company, and therefore it cannot be subjected to tax. So this is very clear. So this ruling in fact helped to say if you're going to do the conversion, you're not going to comply with 4713B, you're fine till the time you're recording the assets and liabilities at book values. The potential capital gain tax impact in the hands of the company is neutralized by this. Having said that, if one were to look at it from a shareholder's perspective, celerity ruling was followed by the ruling of the ruling authority in Domino's. It held that shareholder is taxable on conversion of a company into an LLP, and conversion of a company into LLP is taxable under 247. The point which was discussed over here is there has to be an existence of a party and a counterparty. It is meant. They said it is not mandatory. So party and counterparty is there has to be a transferor and there has to be a transferee. If I'm a shareholder and I become a partner in partnership firm, then there is no existence of a party or a counterparty, and therefore that was the argument which was put forth. And the third thing is non-compliance of a specific condition for availing exemption creates a presumption that such conversions are otherwise taxable. So this was the ruling which was laid down. So this is going to impact all the conversions. So if one were to do a non-tax neutral conversion, then one will have to consider the implications, if any, in the hands of the shareholders of the company. Needless to say, any action, if one were to structure it in a different way, then impact of GAR. So I'm aware of somebody who because I'd heard about this, was planning to do a non-tax neutral demerger, and they said, okay, we will kind of get losses, by doing some other transfers internally, and set it off against that. But let's go ahead with the non-neutral. But tax authorities are going to kind of look at it very differently now in the GAR regime, and therefore this could also be subjected to tax. Okay. One case study which is there is with respect to the 6 million turnover which is there. Say a company A is having revenue in excess of 6 million as on 1st September 19, and in the previous years also it had a turnover in excess of 6 million. Now it proposes to convert itself into an LLP. It is complying with all other conditions, but other than the turnover. Even if company A were to be merged into company B with an appointed date of say 1st April 20, and company B is identified as a company which does not have revenue in excess of 6 million in any of the 3 preceding years. And then immediately after amalgamation, I go ahead and convert company B into an LLP because my condition so the company which I'm going to put under conversion is company B. Can it be said that company B, when I look back for 3 years, it did not have revenue in excess of 60 lakhs, and therefore company B is a company which is eligible for conversion? This can be a subject matter of debate, and possibility that GHAR can be invoked, and tax authorities could deny the exemption to say that there's no genuineness in the merger, or there's no business reason for doing merger of two companies and immediately following it up with conversion. But people have even considered doing something like this in past for making a conversion tax neutral. Moving on to the next subject, which is restructuring of LLPs. Now, restructuring of LLP, so in a company, we can say that there's a hiving off or a demerger. There could be an amalgamation or a reconstruction, or there could be a compromise with the creditors, etc., and winding up. Now, for all these things, one thing which is very clear is there is a provision in the LLP Act for doing a compromise or an arrangement. There's a provision for doing reconstruction or an amalgamation or a demerger of an LLP. So while all this is legislated under the LLP Act, and there are rules which are framed for each of these things, unfortunately, under the Income Tax Act, there are no specific provisions with respect to reorganizations. So, there is an element of ambiguity in terms of how would the tax authorities consider or look at each of these items, so to say. Now, from let's look at demerger, merger, and some of the fund structures which are there, and also a company versus an LLP. This has been in debate, and I thought of putting some of the tax things over here to say whether one should go ahead with a company or one should go ahead with an LLP. And when I look at a company versus LLP, in a company, a dividend payout is taxed in the hands of shareholders now. Earlier, it was a dividend distribution tax and not taxed in the hands of shareholders at their applicable rate. A buyback, there is a statutory limit. I can buy back up to 25% of the paid up capital in free reserves, and the amount that I can use is up to 20. I can buy back 25% of the share capital of the company in 1 year, and that distribution will be taxable at an effective tax rate of 23.29%. There is a provision under 115Q, as we are aware of it. And a capital reduction, there's no statutory threshold on what can be, but capital reduction could have a capital gains tax and a dividend implications in the hands of the shareholders. Now, when we move to an LLP or a partnership firm, it is any modes of repatriation will be remuneration, interest, capital, profit share, and remuneration and interest is tax deductible, subject to limits, and its profit share is not taxed in the hands of the partner, but post paying taxes, profit share can be given. So these are modes of repatriation which is there, and one would believe that LLP would stand out, so to say, because if my effective tax rate is 34.94 and at 34.94 I'm giving out the money, While if I'm a company, and while my effective tax rate may be 25.17% because I have adopted for the lower tax regime, uh, the profits which are thereafter distributed is also taxed in the ends of the partners, and depending on the income bracket in which the recipient is, it can be as high as 36% further on the 75% which is distributed. So, this is exactly so if it's an LLP, so there's a taxable income of 100 and there's a tax liability. We're assuming that the LLP will be more than 10 million and it's 34.94. So profits which are available for distribution is 65.06%. And the total tax outflow from an entity perspective is 34.94%. But if I'm a company, my tax liability could be much lower in different situations. So I may be in the 25% bracket, I may be in the 30% bracket because I have not opted for 115 BAA or BAB. I could be in a 22% plus surcharge, which is a 25% bracket, or I possibly could have been a new manufacturing company in a 15%. And the entity level taxation, except for a company which is not opting for the lower tax regime, uh, entity level, the tax rates for because the tax rates for a company are lower, the tax rates the company looks to be beneficial. Having said that, I'm thinking if one were to go at the last row, which is there, total tax outflow from an investor perspective, in case of an LLP, there is no further tax outflow. So 34.94 is sacrosanct. And there can be nothing more or less than 34.94. Having said that, in case of a company, it will depend on the constitution, it will depend on the legal status, it will depend on the residential status of the investor. Initially I thought I'll put some of these numerical examples, but then there were too many permutation combinations which were there, whether the investor is resident, not resident, whether it's a company, whether it's a individual, whether it's a trust, determine it otherwise. So we had several permutation combination, but so then I'm saying it will depend on that. But if one were to look at it more or less, it LLP stands out to be marginally better, or in some cases where the recipient is in the highest tax bracket, LLP will be significantly better. Because if we just take a numerical example here, to say I have profits after tax of 70 in the 25% situation here, and say 70 is available for distribution, and if the recipient is in the 37% bracket, so more than one third of 70 will go off. So there's an additional taxation of 20, and the net cash received is by the shareholders is kind of or more than 20, and the net cash received is less than 50. Whereas in case of an LLP, the net cash received by the investor or the partner will be 65. So to that extent, it will keep on changing. Of course, if you're in that 15% regime which is there, then possibly it may be different. At 22%, and assuming a normal tax for the recipient, LLP is marginally better. That is what my analysis is. Now, just some of the non-tax considerations also for a company versus LLP is foreign investments. As we spoke, LLP is not as good as a company because LLP has restrictions on foreign investments, because it is permitted only where FDI is permitted under automatic route without any FDI linked performance conditions. Whereas in case of a company, this is not there. But from on all other parameters, whether it is ease of setting up, compliance burden, restrictions under the Companies Act versus the restrictions, if any, under the LLP Act, liability of partner, or or even the deemed gift provisions on partnership interest, etc. This LLP would really stand out as compared to a company. So on the previous slide we said from a tax perspective at entity level we may have a higher tax rate for an LLP, But if one were to consider entity plus investor, then LLP may stand out. And from other considerations also, LLP will be far superior to a company. So this is one illustration which we've put over here, and GUP will be global parent company, global ultimate parent company. See, if a global ultimate parent company is holding shares in a holdco in India, and which in turn is holding shares in a company, and the second structure is it is holding shares in a holdco, which in turn is a partner in the LLP, and there is a dividend which is paid by the company stroke LLP in both the situations, and is received by the holding company, and that dividend is further distributed by dividend by holding company to group ultimate parent. Then what would be the taxation? So say dividend received by holdco is 100, and in LLP structure also we are assuming that LLP will pay a similar 100 to the holding company, and the dividend paid by holdco is 70. So holdco of the 100 will pay off 70. Then holdco will get a deduction to the extent of 70, and 30 will be taxable in the hands of holdco in the company structure. But in the LLP structure, because the share of profit of LLP is not subjected to tax in the hands of the partner, holdco will not be subjected to tax. And therefore, when holdco will pay dividend, see, when holdco pays dividend, the dividend is taxed in the hands of GUP. And assuming that I keep the dividend payout constant at 70, I may be in a better structure in year as compared to a two-tier company structure. It's the point that I'm trying to make. While I'll get benefit of ATM, I'll still be subjected to tax on if I'm not distributing the entire amount. But if I'm distributing the entire amount, then we are in that sense neutral. But if I'm not distributing the entire amount, then I'm better off in a holding company having an LLP in India rather than a two-tier company structure. Now, going to demerger. So we said in a demerger, there are no tax provisions which are there in terms of how a demerger will be there. So for first and foremost, this 219AA talks of demerger of a company, and 219AA does not talk of a demerger of an LLP. But if I want to do a demerger, and demerger essentially is transfer of a business undertaking on a going concern by one company to another company, or by one LLP to another LLP, and in consideration, company issues shares to the shareholders of the company, or LLP issues interest in partnership to the. So because this is not there today, there is a possibility that if one were to go ahead and do a scheme under scheme of arrangement as it is prescribed under the LLP Act, tribunals will be more than happy to grant the approval, but there is a lot of ambiguity in terms of how the same will be taxed in the hands of the partners, or what will be the taxation in the hands of the LLP. So, possible variant which can be considered, these are some structures, and mind you, these are not tested, so to say, but these are possible structures which one can think of implementing is, if say partners in LLP A want to transfer business to LLP B, and the broad agreement between the partners of LLP and partners of LLP B is in consideration of LLPA agreeing to give up its business to LLPB, LLPB will make partners of LLPA partners in LLPB. One could consider doing transfer of an undertaking for a cash consideration. When I'm transferring an undertaking for a cash consideration, and I can restrict my consideration to which is more or less close to my whatever is my net worth under section 50B. Computationally, I will not have gains because my net worth is equal to the consideration which is the receipt for the purpose of transfer. And I have transferred the business. Now, partners will have to introduce cash in LLPB, and which cash can be utilized for discharging consideration to LLPA, and partners will get that cash in LLPA. The question that arises is, like, it earlier would not have been so much difficult, but going forward with the amendments in section 45(4)(a) which have been introduced, if this money from LLPA has to be upstream to partners, like, that can be upstreamed as a share of profit, that is one way, or they can take money out as drawings is the second way. But, like, if they just want to discontinue the LLPA, then possibly could result into a taxable event in the hands of the partners, in the hands of the LLPA, and therefore effectively in the hands of the partners. So will it be more tax efficient than variant one? This will be a fact-based question according to me, but this is a possible option where there will be some visibility in terms of what are going to be my tax implications, rather than, like, doing something in a completely like in an environment where I don't know what is going to be the outcome, because I don't know how tax authorities are going to look at it, or how tax authorities are going to deal with it. So similarly, if one were to consider doing merger of two LLPs, like, there is a specific provision in, once again, in the LLP Act, which talks of amalgamation or of two LLPs. But, like, once again, the Income Tax Act is quite, in fact, very interesting, and some of the members may recollect that when we had this the new code which was proposed in 2010, uh, when Mr. Chidambaram and Mr. Mukherjee wanted to bring a new income tax code or direct taxes code, it did provide for the draft of the direct taxes code, which was open for public comment, did provide for definition of the term business reorganization. And in business reorganization, they had also captured reorganization of an LLP. However, while substantive portions of the direct taxes code have been brought into the Income Tax Act over a period of time, uh, unfortunately, the definition in respect to business reorganization and reorganization of LLPs, which was provided in the Direct Taxes Code 2010, has never seen day of light in the Income Tax Act. So, similar to the earlier slide, in case of demerger of LLP, even an amalgamation or merger of LLP will have a similar issue. And one possible way, therefore, would also be the same, that, you transfer the entire business for cash consideration. And once the business is transferred for cash consideration, there will be a withdrawal of cash followed by a strike down of, or basically making LLPA defunct over a period of time and closing down the LLPA. See, in a demerger, there's going to be other business which is, there is the presumption, and therefore, striking down may not happen. But in an amalgamation, if or everything is credited to partner's capital account, and then the balance is withdrawn from partner's capital account, there is a possible argument to say that, when I dissolve LLPA and I'm distributing to the partners what is there standing to their capital account, uh, there may not be any tax if the amount of consideration, what we discussed in those three scenarios, the cash which is paid out is equal to the balance in the capital account, and there is no revaluation, then there's a possible argument to say that I can achieve what I want to achieve in a tax neutral manner. But once again, this is not tested, and whether it will be effective or not is something will have to be seen based on facts of the case. And also, what is the broad agreement between the parties? Uh, One interesting thing, which is, merger of an LLP into a company. Now, so whether an LLP can be merged into a company, whether there is a possibility, the act is silent on this. And what happened is, in case of Cube Cinemas, uh, Real Images merged into Cube Cinemas. And in case of Cube Cinemas, NCL, a scheme of amalgamation of an LLP into a company was brought before NCLT. And the Ministry of Company Affairs, through the regional director, did oppose the scheme at NCLT also. And NCLT sanctioned the amalgamation, invoking a principle of interpretation which is causes omission, which essentially means that if something is omitted, an event of contingency for which no provision is made or is not provided in the statute, and therefore it will be governed by the common law, and therefore a merger should be permitted. Uh, all statutory requirements were complied with. Provisions of Companies Act 1956, as well as Companies Act 2013 were looked at, and tribunal came to a conclusion that it cannot be considered that Indian, or assume that Indian LLP cannot be merged into a company. And mind you, there was a specific provision under the 1956 Act where this interpretation was there to say a partnership form or an LLP could be merged. Department, when I say department, is the Ministry of Company Affairs, RD and ROC filed an appeal, regional director and the registrar of companies, before NCLAT against the order of NCLT. And the contention there was like, okay, there is nothing in the act which prescribes for an amalgamation of a LLP into a company. And therefore, and if one has to do an amalgamation, then the LLP has to first be registered as a company. And after registering the LLP as a company, you follow it up with an amalgamation. But you cannot straight away come and amalgamate an LLP, which is not a company, into a company. And this was debated. In fact, this debate went on for actually a couple of days, where lawyers from both the sides presented their case to NCLAT. And NCLAT found merit in the arguments which were put before by the regional director and the registrar of companies. And NCLAT also relied on a Supreme Court ruling in case of Rajiv Kumar, that the principle which the tribunal or the legal interpretation cannot be which was adopted by the tribunal, cannot be applied by the court unless there's a clear necessity, and where reason for it cannot be found within the four corners of the statute itself. It is only in that you can apply, and you cannot apply it otherwise. So NCLT in fact said that NCLT has actually exceeded its powers here, and when they have approved the scheme, and therefore the same was rejected. Very similarly, there was another scheme, which was presented to Ahmedabad bench of NCLT, where somebody thought, thought of merging a partnership firm into a company, and this was more or less around the same time. Of course, that decision is not reported, but I'm aware about it. That was also rejected by Ahmedabad bench of NCLT. This brings us to towards the end of fund structures which are there. So if we have a fund which is set up as an LLP, whether it is doable or not, so yeah, that is possible. Sponsors would act as a designated partner, so there will have to be an Indian sponsor, and domestic investors in the LLP would also act as limited partner. And fund can enter into an advisory agreement with the LLP, and then LLP can be used as a vehicle to make investments in the portfolio company. Now, LLP could be structured as or used as a vehicle for structuring an efficient pooling vehicle, as well as the investors could be an the advisory firm could also be an LLP because then it really helps in upstreaming the or giving out the remuneration and taxability thereof. So this has been there, but not very prominent. But this has been there for a while now. So that brings end to my structured presentation, and I'll be happy to take any questions. Of course, there were some 3-4 questions which are already there, and we have a good 20 minutes plus to take up the questions. So Seema and Jayesh, over to you.
Yes. Members are requested to put the questions in the chat box or may raise the hand so we can unmute.
Seema, should I stop sharing my screen?
Yes, you can. Members, please, if any question you have, please put in the chat box.
I think 2 hands have been raised, Seema. Mr.
Okay.
Ashok Mehra and Mr. Ram Prasad Soni.
Okay, please unmute. Arvind, please unmute them one by one.
Can I speak? Shripalji, thank you for an excellent presentation.
Yes.
Thank you, sir.
Very well done. I have only 2 questions. One is there was a slide relating to drag rights and those rights. I missed that slide. If it is possible to display it, I'd be greatly obliged.
I'll do that.
Yeah, and
Is my screen visible again?
yeah, it's coming.
Yeah.
There is a difficulty in providing for drag along rights and tag along rights. So if an LLP, somebody is insistent on that, whether it will be possible to do that or it's not possible.
When it is possible to do that. So I'm just so we are conjecturing over here to say if there are 3 partners or 4 partners, and there is a condition to say that if one partner wants to sell his interest, then he will compel the other partners also to sell their interest in LLP to some identified person. So that can be provided for, but in a company structure, we've seen that very extremely prominently provided to say that you're transferring your shares, etc. But it is extremely difficult to provide for in an LLP, in particular because of the provisions of Section 42. I may actually be a partner in an LLP, but I may not be having any interest because I've already sold my interest to somebody else. And there is per se no control unless there is something in the contractually between the partners which is agreed. It is difficult to monitor and it is difficult to provide for, but it can be done, but subject to legal interpretations.
Provided all the partners have pre-agreed that they will not transfer the right to anybody without the consent of everybody.
Yes. So preemptive rights which are there in a company structure, which we provide for in the articles in a case of a closely held company, or where we have an investor or a private equity coming in and we put a preemptive right there. Some similar things will have to be put up in the LLP. And the minute we start doing that in an LLP, which is a simple form of business, it gets complicated.
Correct. The second question I had was, suppose there is a LLP and one of the partners passes away and he's paid out only the capital that is there in the firm, and the deed says the goodwill of the firm will belong to the partners. Would that still come under the mischief of the current amendment that is being proposed by the government?
So if you can just give some example in numerical terms, so that will be helpful.
For example, there is an LLP with 4 partners.
Okay.
And the deed says that the goodwill of the firm belongs to the firm itself, or to the partners. So if any partner passes away and no new partner from that family is taken over, the shares are reconstituted among the other partners. Whether there would be a tax, because there is no transfer of asset at any fair value or anything, It is just that the profit share is reorganized. Whether there would be a question of tax on the firm.
My view is no, and I'll read out the provision from the finance bill. If if you can just bear with me for a minute. See, so we will not be under 45.4, but we'll be under 45.4a. Now, what 45.4a says, notwithstanding anything contained in this, is my view, subject, notwithstanding anything contained in subsection 1, where a specified person receives during a previous year any money or other asset at the time of dissolution or reconstitution, there has to be a construct, there has to be a receipt by the partner. If there is a reconstitution without any payout, then will it fall in 45.4a? My view is it will not, because this talks of receipt. Now, if you read that same section further, at the time of dissolution or reconstitution of the specified entity, which is in excess of the balance in the capital account in the books of such entity at the time of dissolution or reconstitution. So there has to be a comparison also with the capital account. There has to be some receipt and it has to be compared. My share in profit cannot be compared with absolute numbers.
I appreciate what you say. I fully appreciate what you say.
Yes.
Thank
Hope
you
this
very
answers.
much. These are the two questions I had.
Thank you, sir.
Okay, I think after Ashok ji, now next is Ram Prasad Soni.
Yeah. Hello.
Yes, sir. Ram Prasad sir, if you
Yes,
can
sir.
ask your query.
Yeah. Sir, my query is related to the conversion of LLP to private limited company. The brought forward losses or the carry forward losses of LLP are allowable in the case of company. It is inclusive of the capital gain and the business losses. Capital loss and the business loss both. Hello.
Yeah.
Hello.
Yeah. Just 1 minute. So prima facie, my view is that this is available, but I'm just reconfirming this. So it is only, the provision is only with respect to business losses and accumulated depreciation. So if it is a capital loss, then it will not be allowed for carry forward and set off.
Sir, under which section it is?
So I'm reading 72A subsection 6, which says where a firm has been reorganized, where there has been a reorganization of business whereby a firm is succeeded by a company fulfilling conditions under 13 or 47 or a proprietary concern, etc., then notwithstanding anything contained in any of the provisions of this act, the accumulated losses and unabsorbed depreciation of the predecessor firm or the proprietary concern, as the case may be, shall be deemed to be the loss and depreciation of the successor company.
Section 73?
72A subsection 6, sir.
That is related to the company to LLP, no?
It is related to firm to LLP.
Firm to LLP. So the business losses are allowable.
Yeah, and there is a subsection 6A which says that whereby reorganization, where a private or an unlisted company is succeeded by an LLP, then also there is a similar provision which is there.
Okay. So capital gain is not available. Losses from capital gain.
Yes.
Okay, sir. Thanks.
Okay, now the I think Chetan Darji sir is there. He wants to ask his question.
Yeah. Hi. Thank you for a very good presentation. I just had one question. So, like in case of say the developer, okay, if there is a partnership firm and the partners dissolve the firm and they decide to take the inventory of the assets that they are like few flats or shops that they have, okay. So do you mean to say that in that case, like of course the distribution will be at cost, right? but the market value will be higher than the cost. So the difference will be taxable in the hands of firm.
Yes, because the provision is 45(4), which was there earlier also and now. Means I would believe that if there is a distribution of a capital asset which has taken place, then nothing has changed. Because then also it said like a fair market value will be deemed to be the full value of consideration. It will be taxed in the hands of the firm as
Okay.
capital gain. And one has to look at fair market value. And if in the case that you are suggesting where it is going to be say galas or shops or unsold inventory in case of a developer, the fair market value will easily be linked to the value which is adopted or followed by the stamp authorities for the purpose of levying stamp duty.
Yeah, exactly.
Minimum fair value.
Yeah.
Yeah.
Okay. Thank you. Thanks a lot.
Okay, the next is Mr. Ishwarlal Modi. Sir, if you can ask a query, sir.
Arvind, please unmute him. Hello, Ishwarlal ji.
Hello, Ishwar Lal ji. You can unmute yourself, sir.
I think it is by mistake he raised a hand.
Yeah.
Okay, no problem. I think there is no more questions.
Yes.
Okay, thank you.
There were two questions which were there in that message which was sent to me. I'm not sure if I've covered them, but
Okay, we will just go through the same. Yesterday's questions.
I have on my mobile. So for benefit of everybody, if you can look it up.
Yesterday's questions, if you have, Jayesh ji, you can share
So
this.
one question which Mr. Rajesh Kumar Shah had asked was dissolution of LLP and the process.
Yes.
So on the dissolution, there is a regulations which are specifically framed way back in 2010, and this process is extremely similar to the process which is there under the company law for dissolution of a company. And I have not seen an LLP being dissolved, or I have not personally handled one, but I would believe that looking at the provision and when I looked at this query from Mr. Rajesh Kumar is the time when I re-looked at this LLP dissolution, because I never encountered it. I would believe that it should take about a year and a half to 2 years, because there also we will require confirmation or clearance of all the tax proceedings which are there, and which normally will take a year and a half. It requires appointment of a liquidator similar to that in case of a company. So it's the process which is extremely similar. There is a specific regulation which was been framed in 2010 in this regard. There's one question from Mr. Bhavesh Dalal on property is transferred to partner, then what is the tax position? So this is very similar to the question which was asked by Chetan, that if the property is transferred, then there will be tax implication, capital gain tax implications in the hands of the party. I think Mr. Ashok Mehra had asked question. I think his question. So your questions are covered here. Like what? So one question was explain the taxation applicable in case of change in profit share, which we answered. And the second explain taxation in case of change in profit share for firms like CA, etc. So that does not change. So we answered that. And Mr. Sanjay had asked a question on whether conversion of a LLP to private limited or from private limited is possible. If yes, what are the tax implications for LLP company, partner, directors, and shareholders? So conversion is possible if we are doing conversion in under 4713 or 13B. Then there will not be any capital gain tax implication, and it can be safe to assume that there should not be any implication in the hands of partners as well. But if we are not in compliance, then there could be like, if the recording is happening at book value, what there is a judgment of celerity should not matter, but there could be tax implications in the hands of shareholders as well as partners. So I think these were the questions which were there yesterday. So
Okay, sir, I think Shitanshu sir has raised the hand to ask some questions. Shitanshu sir, if you can ask.
Am I audible?
Yes, sir.
yes, sir.
Okay, I've got one question that there is a proprietorship concern which was in the business, which is a factory, land and building, and plant and machinery. Now it has got into partnership with some other persons and has introduced his all these fixed assets, which was reflecting in the balance sheet in the partnership firm by way of an agreement. And he has transferred the value much higher than the value what was reflected in the books of accounts. Now, only question is that in regard to land and building, which is GIDC, whether the valuation what has been put into the partnership, whether the condition of the fair market value will apply there also.
Is it an LLP or is the partnership?
He has entered into partnership.
No, but
and he
it's
introduced
no. So the form is a partnership under Indian Partnership Act, or it is
Yes.
an LLP.
the Indian Partnership Act.
Okay, so
His
and then
his proprietorship firm, he
Yeah.
gets into the partnership, he transfer all his assets to
Hmm.
the partnership firm by way of his capital contribution.
Hmm.
Now, the asset constituted land and building, factory land and building, and other plant and machinery.
Hmm.
He, in the partnership deed, he lists all the equipment or whatever asset is transferring at a particular value to be credited to his capital account.
Hmm.
Now, question is about the land and building, which is in GIDC. He transfers an X value. Say the book value was earlier about say 20 lakhs of rupees, but he transfers at 2 crores of rupees.
Hmm.
Will the valuation aspect will come into triggering, or as far as the GIDC land is concerned, where the fair market value may be more than that or maybe less than that?
Yeah, so so I got your query. So,
Yeah.
so I'll address it in twofold. First and foremost is we are concerned with provisions of 45.3.
Correct.
Now, 45.3 says the value at which it is recorded in the books of the partnership firm
Yeah.
deemed to be the full value of consideration for the purposes of computing capital gains in the hands of the partner.
Okay.
So that is very clear. It is a settled principle. So if say assets are worth 20 lakhs in his books and he's transferred it at 2 crores, then 1 crore 80 lakhs is the capital gains.
Absolutely.
Now, the second point is that the fair market value of the immobile property is say not a crore but 3 crore. Of the 2 crore, 1 crore was immobile property. It is not 1 crore, but it is 3 crore.
Yeah.
The question that arises is whether 50C will have a play over here or not.
Yes.
So there are precedents or rulings that suggest that if 45 between 45.3 and 50C, because 45.3 is a specific provision and 50C is a deeming fiction. Deeming fiction does not override a specific provision. In fact, last year or some, there was a ruling around this which came. So, and in fact, if my memory serves me right, there are at least couple of rulings which support that 45.3 will override 50C, and 50C does not have a play when assets are contributed to a partnership, in particular land and building.
Okay. Sir, one more question, if you don't mind.
Yeah.
See, now there was a Bombay Court judgment which says that if a long-term capital asset is transferred, though there was a depreciation claim on that, still it can be treated as a long-term capital gain. I think S Builder case of Bombay High Court. So in that particular case, because there is a provision that if the depreciation is claimed, it will be deemed to be a short-term capital gain. But the Bombay High Court ruled that if the asset is held for more than 3 years, long-term capital asset, you can still treat it as a long-term capital gain. They can take a benefit of section 54 or 54F or 54 EC. The question arises, how would you determine the tax of return? Because when you file the return, it automatically catches a short-term capital gain. How would you treat it as a long-term capital gain? If I were to take a benefit of the judgment.
So I have not read this judgment, but if you can, I'll make a note of this. Which judgment are you referring? If you have the citation,
Bombay High Court S Builder, ACES Builder.
Okay.
This came, I think, about 4 years back, which categorically stated that the asset is a long-term. The depreciation is claimed on it. Since the asset is long-term, it is a long-term capital gain, and you can take a benefit of section 54.
I have not dealt with this, but I'll look up on this judgment and I'll come back.
I will, if you share an email, I'll email you the judgment copy also to you, sir, just for your reference.
I'll share my email ID on the chat.
Yeah, please. Thank you.
Okay,
nice
sir.
presentation, sir.
Okay, sir. Sir, since we have 5 minutes more, I think Vishal Modi has raised his hand. If we can raise his question. Yeah, Mr. Vishal.
Sir, in LLP, profit balance where we have to transfer to capital account, or we have to create a profit and loss appropriation account?
Sorry, I didn't get the question, Mr. Modi.
While finalizing the account of LLP,
Hmm.
the surplus balance of profit and loss account will be transferred to capital account of the partner, or we have to create a profit and loss appropriation account, just like limited company?
No, it goes to the capital account is not my understanding. Because though I'm not an accounting person, I generally advise on tax aspects, but my understanding is it will go to the capital account.
Sorry. Thank you, sir.
Sanjay Damania, sir. If you can raise your query.
Hello.
Yes, sir.
Speaker sir, I have one query regarding whether the LLP can be converted into private limited company, or vice versa, private limited company can be converted into LLP.
So answer to that is yes, it can be. There is provision under Companies Act as well as the LLP Act, and there are specific exemptions also which are provided under 4713 and 13B for the conversions.
Okay, and if both way it is possible, what are the conditions which are to be satisfied in order to get this exemption? If we contravene any conditions, what are the tax implications in such case?
So the conditions are very onerous, and the conditions are explicitly mentioned in the presentation. So the presentation we will share, we've already shared with Seema and team, so will be made available. So the conditions are very categorically listed.
Okay.
What happens if these conditions are not complied with also is mentioned in the presentation. So there are a couple of rulings which have come. One is in the case of celerity, and which says that if the transfer happens, but while it is not compliant, but at n is recorded at book values, then there cannot be any capital gains on conversion in the hands of the company or LLP or the partnership firm, as the case may be.
Okay.
But in the hands of the shareholders, so if a company is getting converted into an LLP, there is another ruling in the case of Domino's, which is a ruling from Authority of Advanced Ruling, AAR ruling, which very clearly says that it is a transfer and partners will be subjected to capital gains. And then what is what are you transferring? So if a company is getting converted into an LLP, you are transferring your interest in shares in the partnership in the company and getting interest in the LLP. So then there will be a computation mechanism which will come into play.
Okay. And regarding immovable property transfer?
See, immovable properties can be transferred as part of it. One will have to look at the state specific stamp duty laws to figure out what will be the stamp duty liability.
Okay.
See, there is one judgment in the case of Vali Pratibha Rao, which is an Andhra Pradesh High Court judgment, which says that on conversion there cannot be any stamp duty liability. But the local authorities are not paying heed to that judgment.
Okay. So we need to see if it is in Maharashtra, we need to see the Maharashtra Stamp Duty Act and the
yes.
relevant provisions of that.
And also what becomes very critical is one needs to look at the definition of the term conveyance. You may not find anything in any of the entries in the schedule, but if you look at the definition of term conveyance, if my memory serves me right, either in Telangana or Andhra Pradesh, they've gone ahead and changed the definition of the term conveyance. So if one looks at the schedule, you will not believe that there is any stamp duty, but then conveyance is covering. So then the stamp duty applicable on conveyance will be made applicable.
Okay. Thank you very much for your nice view, sir, and nice presentation.
Thank you.
Okay, now Mr. Chetan has raised the hand. Sir, Chetan sir, if you want to ask any question.
Hello.
Yes, sir.
Hello. Yeah. So coming back to my earlier question, so as we discussed, right, that when the property is transferred to the partners, it will the fair value, the difference between fair value and the cost will be taxable in the hands of the firm. What will be the cost of acquisition for partners?
It is taxed in the hands of the firm.
Yeah, I agree.
So the cost of acquisition in the hands of the firm has to be seen.
No. See, fine. The property has been transferred to the partner, right? It's an inventory. Okay, say for example, inventory of 3 flats. Okay.
Okay. So I get your question. The fair market value which is adopted for the purpose of computing capital gains in the hands of the partnership firm will be the deemed cost in the hands of the partner.
Okay. Thank you.
That's logical thing because tax has been paid on that by somebody.
Yeah, of course. That is why I asked this question. So.
Okay, I think questions are over now. Over to you, Seema ma'am.
Yeah, thank you, Shripal ji, for the wonderful session and for explaining the taxation and structuring of LLP. The presentation is very detailed and you answered all the questions raised by the participants. I now request CA Krishna Kumar ji, the Deputy Convener of JB Nagar CP Study Circle, to present vote of thanks to today's speaker.
Thank you, Seema for giving me this opportunity. Today's speaker, Sri Shripal Lakdawala ji, has very well covered the topic, taxation and structuring of LLP. Sri Lakdawala is associated with LLP work since inception and has also been associated in setting up few of the early LLP setup in our country. Mr. Lakdawala has given the examples and quoted few case laws and also clarified the doubts of all the participants. On behalf of JB Nagar CP Study Circle, I propose a hearty vote of thanks to the speaker, C. Lakdawala ji, for the excellent presentation and sparing the time out of his busy schedule and enhancing the knowledge of our members. Before closing the session, I would like to say that today is the World Sleep Day, and the slogan for the day is better sleep, better life, and better planet. So enjoy the sleep and enjoy weekend and attend our tomorrow's webinar. Thank you.
Thank you.
Thank you, Krishna ji. Thank you, Shripal ji.
Thank you.
Thank you.